monetary policy. Monetary policy has to do with credit and interest rates. Okay? All right. Now, in order to understand monetary policy, we have to talk a little bit about the money market in more detail than we've done before. When we talk about the money market, what we really mean is all financial markets. Okay. Now, the Federal Reserve is a branch of the government. Okay, and unlike in most countries, the Federal Reserve is really independent of the rest of the government. Okay. The Federal Reserve is what we call the central bank of the United States. Every country has a central bank. The Federal Reserve has three main responsibilities. The first one is it provides banking services to banks. What do banks do? What are the two things that define a bank? Yeah?
Accept deposits and make loans.
Accept deposits and make loans. The Federal Reserve acts as a bank to Wachovia and Bank America and all the commercial banks. So the Federal Reserve holds reserves for each commercial bank. They accept deposits in the Federal Reserve. And they also are available to make loans to commercial banks should those banks need them. So they act just like a big bank to all the banks. Okay, so that's number one thing that it does. Number two thing that it does is it regulates the banking system. It decides what kinds of investments banks are allowed to invest in. Okay? When you make a deposit in your bank, the bank may not take your money to Atlantic City and play roulette with it. That's illegal because the Fed says that's not a safe investment for banks to be engaged in. Okay? Banks may not even take your money and invest it in the stock market. That's also illegal because the idea is banks should be making safe investments and the stock market goes up, sure, but it also goes down. So banks aren't allowed to invest in the stock market, at least not directly. The third thing, and the most important thing that the Federal Reserve does, is it controls the supply of money, or at least influences the supply of money and interest rates. Here's the hard question. How does the Fed control the money supply? Okay? And by inference, how does it control interest rates and credit conditions? Okay? The answer is it's a complicated process, but the simple answer is they do it by supplying or withdrawing reserves from the banking system. Okay? Supplying or withdrawing reserves from the banking system. Banks can borrow reserves from the Federal Reserve. That's why there was that distinction in there between borrowed and unborrowed reserves. They can borrow reserves from the Federal Reserve, but the Fed can also unilaterally increase or decrease the amount of reserves in the system. Okay? Now there are three, in theory, there are three tools that the Fed can use to do this. But in practice, only one really matters. The three tools are changing the required reserve ratio, which is the percent of deposits that reserves have to hold on to. That gets done less than once a decade. It may be 20 or 30 years since they've done that, so it's there in principle, but they don't really use it. The second one is changing the discount rate. The discount rate is the interest rate that banks pay when they borrow money from the Fed. Okay? And so clearly, I mean, if you just think about it, higher discount rates should reduce the amount of borrowing from the Fed, and lower discount rates should increase it. But as a practical matter, the Fed doesn't use the discount rate for that purpose. Rather, they use it primarily as a signaling mechanism. When they want people to notice that there's been a change in policy, they change the discount rate. But usually the policy has already happened. Okay. The one thing that they do use the one tool they do use is called open market operations. Open market operations is when the Fed supplies or withdraws reserves from the banking system. This is done pretty much every business day. Okay, they have a target for what they want bank reserves to be, and they either add a little or take a little away to make sure that they're on their target, basically. Okay, and when there's a policy change, the open market operations are quite large. But the point is, this is their go-to tool. Okay. Okay. Now, there's a simple formula here, really a simple formula. Money supply equals MM times bank reserves. This is a number, like 4. It's just a proportionality thing. The idea is the money supply is some multiple of bank reserves. So when the Fed increases the amount of bank reserves through the process that's described in, I think, Chapter 18, you get an increase in the money supply, and vice versa. Okay? The Fed has pretty good control over the amount of bank reserves. It has less control over the money supply. There's, even though the equation makes it look like a fixed relationship, it's not a fixed relationship.